Big US tech shares have, in many cases, come off their highs a little bit, but they're still near record highs. And they had this massive run. Some investors are concerned about overdone AI-driven gains. Let's get more from Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute. Thanks very much indeed for joining us, Scott.
Morning, Andrew.
Do you think a year from now we'll look back and think, oh, gosh, that was quite the AI bubble? Is there a risk that we're in an overinflated AI euphoria?
I think maybe in the nearer term, I think we could see a pullback in the nearer term. But, you know, we're looking for at the end of next year for the S&P 500 to be around 7,000. So, you know, if we're going to get to 7,000, the AI, interest is going to continue, and it's going to be these big growth names and probably these mega cap names that are really into AI that are going to get us there. So I think that, could you say there's a little bit of a bubble? Well, probably you could, but when you look at the numbers behind this, if it's data center spend, CapEx, all these sorts of things, these numbers just keep coming through, and the spend looks like it's going to hold. So I'm not sure I would use the term bubble right now, but certainly these AI-related stocks aren't cheap.
We heard earlier from a guest, Andrew Slimman, a strategist, who said that, people shouldn't worry about a narrow market. It's perfectly rational buying these Mag 7 stocks to generalize because they're so profitable.
The big difference, and I get asked this all the time by clients, is they want to compare, the late 90s, 2000 with what's going on now. And I think that the difference is that the companies now that are leading the charge, and the market has been narrow, they're real companies. They have real products with real revenues and real cash flows. And that really wasn't the case in 99 and 2000. Those companies were largely priced on what might happen down the road. So I think that these are real companies. They're going to continue to drive earnings growth, CapEx, and those types of things. And saying that, we're overweight the technology sector. We had been overweight communication services, but we backed off a little bit on that. Basically, there's two companies that determine what's going to happen in the communication services sector. We're trimming a little profits there. We've been trimming from small caps. So we're trying to use that quality kind of an outlook, which for us, that's, good cash flows, good balance sheets, those kinds of things. And so I think that's going to continue to be the case as we move through the rest of this year and through 2026.
What are the big ones? Communication services. What are the two big names there? Just remind us.
Well, I mean, that's Meta and Google.
Oh,
so,
of course, yeah.
We always hear a lot of talk, and of course, these retailers are apparel retailers make up a lot of consumer discretionary, and there's a lot of talk about them. But the thing is, with that sector, I mean, that's almost no matter what those stocks do, they're not going to be the drivers of that sector. Their cap size is just too small. So I would argue that communication services. I got mixed up with consumer discretionary there, forgive me, but communication services is going to continue to be driven by these two big cap names, and you really have to have a good feel for what they're going to do for you to make a call on that particular sector.
Right, and I'm not sure. Can you talk about individual stocks, or do you want to stick to broad?
Well, yeah, Andrew, really, I don't cover individual stocks, and so I'm not an expert on that. I might have a 30,000-foot view on it, but I'm not sure it's really going to help your viewers to ask me too much about a specific stock.
Broadly, though, AI. I know we've touched on this, but is there a risk that just too much is being spent too soon?
Well, I think there is, and you can tell a lot of, there's really only a handful of companies that are making money on AI. And we know what those names are. And there's a lot of companies that are trying to use AI, but it's an expense for them, and they haven't monetized it yet. Now, is that going to change over the next 3 to 5 years? I think it will. But right now, I think that's what needs to happen, is more companies need to be able to monetize this rather than just having it be an expense on their income. That's what's going to make the difference. And I think that's going to happen. But like any new technology, especially one that's, come on this fast, I think it's going to take a little while.
What about Jay Powell? Tough job for him. It's really not clear if the U.S. economy is under threat. Jobs have been fairly solid. Do you think we'll get any clue from him tomorrow at his speech?
I would like to think so. And, you can make a pretty rational argument right now. We've got 4.2% unemployment in the U.S. That's way, way below the 60 or 70-year average. We've got inflation that's been creeping a little bit higher. That's certainly above where the Federal Reserve wants to see it. I mean, we only think they're going to cut rates once this year. September's certainly a live meeting, and then once next year. So, when inflation's higher and the unemployment rate's pretty low, it's hard to say, hey, the Fed's ready to step into a big cycle where they're going to, do a bunch of cuts. I'd like to think, and historically, Jackson Hole, the Fed chair speech, has been used to indicate a policy change, or at least some sort of an adjustment at the September meeting. And I'd really like to see some kind of a hint from Jay Powell one way or the other. I'm afraid he's probably going to say, we're going to see what the data says, which, for me, you got the largest, most powerful central bank on the planet, and you're telling me they're going to wait for one CPI report, one employment report to make a decision. That doesn't make a lot of sense to me, but he could very well take that route tomorrow. I hope not, but he could.
Yeah, it must be so tough. I wonder, does he stay up late working on a speech? He must. I mean, we know that every word has to be weighed.
Yeah, it does, and I mean, I've been doing this for 40 years, and you decipher, you go through every word of every sentence of these statements, and you can just see, the statement's one thing. Tomorrow, obviously, he'll be talking live, and as he says things, the market's going to be moving on that. So it is tough, and like I said, I mean, it's not clear that the Fed needs to cut rates a lot, only because inflation is higher, and the labor force, I mean, he just described it 2 months ago before the last labor report, that U.S. employment was at or near full employment. So, here we are 2 months later, and you're going to cut, indicate that you're going to cut rates a whole bunch. I just don't think so. But, I heard an interview this morning with James Bullard, who was our former St. Louis Fed president, and he said he felt like rates should, in these next 3 meetings that we have left this year, should be cut a total of 100 basis points, which, that kind of surprised me. But I don't know if he's gunning for the Fed chair job or what, but that seems excessive to me. If they cut once and kind of threw the president a bone, so to speak, okay, I can live with that. But what are you going to do if you cut a bunch of times here over the balance of the year, and then inflation creeps higher next year? I don't think that's going to happen, but I think in the near term, between now and the end of this year, the CPI, headline CPI, is probably going to move, up a little bit to a little bit north of 3%. I mean, that's not what the Federal Reserve wants to see.
I forgot to ask you about this. I always love the fact that people watch the American Association of Individual Investors, and when they're bullish, it's seen traditionally as a bad sign for the market. But they have turned more pessimistic lately.
They have. It's in negative territory, but the latest reading that I saw, it's negative, but it's not at an extreme. So it's kind of in the middle of the road. And I look at it as a good contrarian indicator, and there's other contrarian indicators out there. But certainly when individual investors, when they love stocks and their friends love stocks, and it's just blue skies ahead, nothing to worry about, that's when you need to start worrying. If this moves to an extreme on the downside when they're bearish, and I mean it wouldn't surprise me in that case if the market keeps going up, because it's just when everybody's leaning one way, whether it's I love stocks or I hate stocks, usually the opposite happens. But right now, investors are less enthusiastic about U.S. stocks, but they're not at an extreme. So that's something to pay attention to, but it's nothing, at least right now, to try to act on or insert into your portfolio strategy.
And I mean, your advice, I think it's kind of evergreen advice at this stage. Look for strong balance sheets in the equities you buy and reliable earnings trends.
Yeah, Andrew, I tell you, in a lot of cycles, most cycles, as you look back over a long period of time, when the U.S. is coming out of a recession or a severe contraction or a severe slowdown, people are willing to take on risk, and they'll buy companies that are, let's say, Russell 2000 companies that really don't have good balance sheets and cash flows. That's what typically almost always happens. But we're not expecting a recession to begin with, and we're really not expecting any kind of an earnings contraction. So I think right now, when you look ahead, it's going to be hard for these less quality Russell 2000 type stocks to catch up or stay on pace with these big growth companies whose earnings growth rates are just spectacular relative in the S&P 500 relative to the 490 companies that aren't driving the market. And so I think the gap might narrow as we look out over the next 12 months. The big mega caps earnings growth would probably slow a little bit, which I don't think is a big problem. But I think that for right now, I think you do have to stick with these companies. Whether you're buying bonds or buying stocks, you need companies behind them that have good balance sheets and good cash flows and things like that. So at some point down the road, people will be willing to really take and hold and buy a lot of less quality types of assets. But I just don't think that's going to be over the course of the next 6 months, 9 months.
Scott, thank you very much indeed.
Thanks, Andrew.
Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute.